Okay, so let's straight away get to our market master of the morning, Trideep Bhattacharya, CIO Equities at Edelweiss AMC is with us. Trideep, thanks for joining in. Let's straight away get to the earnings math. Are you happy with the fourth quarter overall? I can tell you that, we are pleasantly surprised because usually at this time, the fag end of the earnings season, you get all the misses, all the negative numbers. But, look at this morning, stocks like Triveni, etc., MedPlus, plenty of excitement and good movers here.
Yeah, I think in and around the result days, one should look at these movements more as positioning ahead of results more than anything else. But I would say if I look at the result season on the whole, I think after a fairly disappointing December quarter numbers that came through in the form of the gap versus expectations, in this time, it's been broadly in line. So we'll still have on net balance an earnings cut of maybe 1 to 2%. But last time it was kind of fairly varied and fairly strong. So from that perspective, I would say broadly earnings have met expectations. And in the context of what's happening globally on the geopolitics side and also in India, that has held the market's nerves quite well of late.
So for the stocks you own, I mean, whether it's your universe or even if you talk about general Nifty earnings, what is the expectation that you have for this year, FY26? Yeah. And has the risk of downgrades receded? My basic question is that will earnings give us the ammunition to take the market substantially higher?
Yeah. So I will start with the earnings and then lead it on to the markets. My working hypothesis is that the earnings would actually come back to the fore in the form of earnings upgrade, which we started, on the downgrade cycle somewhere in the middle of last year. And we will kind of cross that over and finally get into an upgrade cycle in the second half of fiscal year 26. This is driven by mostly 3 or 4 positives which have happened in the light of so many geopolitical negatives that we have seen. One is that oil has cracked almost 25% plus, which India being a big importer is a big positive from a consumption standpoint. Second, inflation has come off about 100 basis points overall. And third, rate cuts, 50 bps so far down, probably more to go. And finally, the impact of, the middle class bonanza that we saw in the context of union budget announced by Honorable Finance Minister, that has not yet kicked into gear. So I think from a back half of the year standpoint, the ducks are lining up quite well in general for the economy and particularly for the earnings. Might I add, of late, of course, monsoons have arrived a couple of weeks in advance. If they stick to the plan, then that will also kind of be good from the rural economy standpoint. So I think, give it a couple of quarters, economic decision-making has started in India. We will see that translate into earnings in the second half of FY26. That's why we are not negative on earnings overall. However, valuations today are fairly close to September 24 peaks. And earnings still have a couple of more quarters to go. So net, I think from here till about the time when we see earnings come back, you might see a bit of a plus minus 5% market kind of a situation. That's our prognosis of earnings and markets, Surabhi.
By the way, look at MedPlus. I think it's up 6%. We had the management with us. It's back. It's into 4 digits now. So interesting. Off the high, by the way, but still holding above the 1,000 rupee mark at this point. LIC, of course, is the other one. Is the number 2 volume-led gainer right now with a 4% pop. The big underperformer within life insurers in India. The private ones have all done very well. But this one is not. You'll hear from the Hindustan Copper Management. That stock is also up about 3%. Techno Electric, I think we spoke about it earlier. PG Electroplus is another one which is up about 2%. There are these RITES and IRCON. RITES is up 6 and IRCON is up about 2%. So there is a fair bit happening, although it's not showing up in any meaningful way as far as the index is concerned. Trideep, good morning.
Morning.
Anything out of in the defense space that you own, that you like? I was looking at, and it's not just the HALs of the world, right? There are smaller companies. A company called Centum Electronics was up 10% yesterday. 1,200 recently, 2,500 is at least till yesterday. And there are many, actually. Smaller companies, but of course, they're all, you got to focus on the technology and are they the cutting edge? And I mean, not easy for the layperson to assess. I don't know if you've looked at any of these names.
I think very clearly post the recent geopolitical conflict, India's defense companies and their capabilities were tested. and they've actually come out in flying colors. So one of the things that, of course, war means negative. It means from life and geopolitical standpoint. But from a business opportunity standpoint, from a medium term, it opens up exports as an opportunity for defense to come through. That's something that we have been kind of mildly warming up to. We have been overweight into defense heading into the last few months, and not just the two leading PSUs, even beyond that. But we think that a good bit of that rally from a very near-term standpoint is kind of in the price. So we would wait for a bit of a pullback for us to kind of load up again. So to answer your question, structurally positive, Indian defense has come of age. Defense as an exports opportunity will probably kick into gear over the next 3-5 years. But near term, I think the markets capture a good bit of positives.
All right. Hi, Trideep. Good to see you again. Trideep, you're positive on tech post the recent pullback. Tell us, what is your preference in that space?
So tech, in our opinion, at the moment is a game of expectations more than earnings. We think that, this is the worst possible time from an economic decision making from a tech US and global standpoint. And hence the expectations are very reasonable with regards to earnings overall. Valuations are also in line with that of last 10-year average within pockets. And hence, while we were underweight till about a few months ago, we have covered that. And incrementally, we would probably be looking at it, favorably as we get into next year or so, where hopefully Trump's tax cut plans in some shape or form comes into gear. And that would mean better days for US corporates and hopefully as a follow-on on Indian IT companies as well.
Trideep, what's the biggest house overweight? I mean, across schemes, across funds, if I were to ask you about the one dominating sector, what is it? I mean, is it the obvious financial services? Is it something else?
We are heading towards a meaningful overweight towards consumption, Sophie. We are probably not there yet. We want to time it in the sync with so that we get the right prices. Themes are all fine. We have to marry it with valuations so that we kind of get the best of both worlds. But I think we are heading towards probably better days in consumption in our view as we get to the back half of this year. I highlighted a few reasons, and our portfolios are gradually reflecting that conviction over a period of time.
And, consumption is a very big basket. So within that, are you talking QSR, FMCG, jewelers, shoemakers, I mean, or the whole play?
Consumer discretionary and the premium to start with.
Okay.
If the monsoon and the inflation going down sticks to plan, then maybe over time staples. But that's the way, that's the sequence that we are headed.
Okay. All right, Trideep, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here. And really good to get that perspective as always.